What is a CFD? CFD stands for a contract for difference. The trader and the broker agree to exchange the difference in price of an asset at the beginning of the contract and at the end of it. Basically, using CFDs, traders buy or sell assets without actually owning them. Essentially, the trader predicts the asset price direction, and if the forecast is right, the trader earns a profit. If the forecast is wrong, the contract will result in loss for the trader. Note that it is up to the trader to decide when the position should be closed. Let's take an example. Mario would like to buy 1,000 stocks of Company A that currently cost $20 each, forecasting that they will grow in price in the future. Mario pays $20,000 to the broker for 1,000 stocks. After a period of time, as Mario predicted, the price of stocks increases. Now they cost $25. So Mario closes the contract and sells the stocks. As Mario's forecast is correct, he receives the price difference in the amount of $5,000 from the broker. But what if Mario's forecast is wrong and the stocks drop in price? In this case, Mario will have to pay the difference to the broker at the end of the contract. CFDs are available for almost any asset: oil, gas, gold, stocks, currency pairs, cryptocurrencies, etc. What is leverage? CFD trading allows traders to use an additional tool called leverage. Leverage is used by traders to borrow extra funds from brokers. Like in mathematics, leverage increases the trader's initial investment by a certain percentage, but it also puts it at risk. As leverage poses serious risks for traders, especially in periods of high volatility, it should be used with attention and caution. So, how does leverage work? Let's study two examples. John has decided to open a CFD position and invest $100 in stocks of Company A, expecting them to grow in price. John uses the 1-to-1 leverage, which means that his profit will increase by 1% if the stock price grows by 1%. So if his forecast is right, John will gain $1. Having the same amount of money, $100, Stephen decides to use the 1-to-10 leverage. In this case, if the price grows by 1%, Stephen's profit will increase by 10% and will result in $10. But what if the price goes in the wrong direction? In this case, the losses will multiply accordingly, but you'll never lose an amount larger than your original investment. On our platform, leverage is located in the right menu just below the amount settings. Note that leverage may differ depending on a broker, the type of an asset, and the time of a trading operation. How to close your position automatically. Automatic closing is used for controlling the risk or the reward from a trading operation. For the position that has already been opened, you can set up auto closing by clicking on the settings icon next to the close button on the top right-hand corner. For a new position, use the auto closing button that is located above the buy button. Specify when the position must be closed, when a certain level of profit, take profit, or loss, stop loss is reached. Note that you can set the profit or loss value in percentage, in money, or simply put the asset price. Auto closing is reflected in the chart as a green dotted line for take profit and as a red dotted line for stop loss. Please note that these lines can be shifted up or down manually by using a cursor. The values corresponding to the lines change simultaneously with manual shifting. When specifying the desired loss limit, you can also enable the trailing stop mode. The trailing stop mode automatically shifts your loss limit up or down as long as the asset price moves in the desired direction, so the position remains open. In case the price moves in an unfavorable direction, the loss limit will not shift. Please note that the settings will also be applied to any new position you open. How to keep a position open even at 95% loss. There can be a situation where the loss on a position reaches 95%. Nevertheless, you have a possibility to maintain the position open. In order to do this, you should click on the Auto Closing button and select Use Balance to keep position open. If the loss for a position reaches minus 95%, an additional 20% of your initial investment amount is reserved in your account. If the position continues taking a loss, your available balance is reduced by 20% again and again. Once the position rises to at least minus 94%, all previously reserved funds are returned to your balance. You can limit the additional funds reserved on your balance by specifying a level of loss that is acceptable to you for this position. From the list of trading instruments, pick FX or CFD. These two instruments share the same trading engine, but are used for different assets. Currency pairs traded via Forex and stocks via CFDs. Select the assets you'd like to trade. Enter the amount of money you're willing to invest. Select an appropriate multiplier. A multiplier will allow you to invest a larger amount than the one you have on hand, which means your potential profit will be bigger. However, the losses you could incur would also be multiplied by the same number. Depending on whether you believe the asset is going to appreciate or depreciate, click Buy or Sell. Click on the Auto Close option to specify the stop loss and take profit price levels. A stop loss restriction automatically closes your trading position when the losses on that trade reach a certain amount. Similarly, a take profit restriction will automatically close your position once a certain amount of profit is made. The position will remain open and active either until the auto close limits are reached or until you decide to close the deal yourself. You can manually close the position whenever you see fit by clicking on the Close button. How to open a position automatically. Trading on our platform, you can open positions automatically. In the menu on the right-hand side, just below the Sell button, click on the Purchase At button. You can either choose the current market price of an asset, which is set by default, or by clicking on the plus or minus buttons, indicate any other value at which you feel comfortable to have the position opened automatically. After setting the price of an asset for automatic opening of the position, click Buy or Sell to indicate the direction of a new position. Depending on the direction of a new position, you will see a green dotted line for Buy or a red dotted line for Sell that will be indicating the opening price level. Once the price reaches the indicated level, the position, also called Pending Order, will be opened automatically. In order to modify the pending order, mouse over the pending position on the chart, click on the Settings button and change the available parameters. If you wish to cancel your order, click on the X button located next to the Settings button. If you would like to disable the automatic opening feature, simply click on the Close X button. What is slippage? While trading CFDs, you can face the slippage effect. Let's take an example. You see that stocks of company A cost $62 and are rising in value. You decide to open a buy position at the current price. But after the position has been opened, you notice that the opening price was $62.50, not $62. The occurred difference, 50 cents, is called slippage. The slippage effect can be positive or negative. In our example, the slippage effect is negative. But if the trade was executed at $61, the difference would be $1 in your favor and the slippage would be positive. Slippage occurs when market prices fluctuate quickly or as a market reaction to some breaking news when major events happen. As a result, the number of buyers or sellers increases, heavy trading volumes occur and trades are executed at high speed. So, the price requested by a trader at the beginning can be unavailable on the market, and a broker offers a trader the next best price. What is an overnight fee? CFDs, cryptocurrencies, and commodities are subject to overnight fees. The overnight fee is applied when a trader doesn't close a position and holds it open overnight. The overnight fee is needed to cover the cost of the leverage a trader uses overnight. The amount of overnight fees differs for long positions, when you are buying an asset, and short positions, when you are selling an asset. The fee is charged every night at 2100 UTC. To check the amount of the overnight fee related to a certain asset, please go to iqoption.com and check the overnight fee section. Next to each asset, you will see the following information: the days when the fee is applied, the time when the fee is charged, the amount of the fee for short and long positions. Please note that the amount of the overnight fee as well as the days and the time when it is applied may change depending on the situation on the exchange.